Hello, students. The topic which we are going to discuss today, that is flexible budget. So let's discuss what is the expected accomplishment of today's session. First of all, we will discuss what is flexible budget. Then we will discuss to whom flexible budget usage is suitable. What is the difference between flexible budget and static budget? What is the format of flexible budget? What are the advantages of flexible budget? And what are the disadvantages of flexible budget? So let's start with what is flexible budget. Flexible budget is a budget that adjusts or flexes with changes in volume or activity. It means your budget figures are going to be changed when you are changing your activity level. For instance, right now you are preparing your budgeted income statement, and over there you are expecting that you will sell 10,000 units of product in next accounting period. Now, by having flexible budget, if you are going to change your activity level from 10,000 units to 12,000 units or 8,000 units, your budget figures will change. It will flex, it will adjust with the changes in volume or activity. So it means flexible budget is more sophisticated and useful as compared to static budget, which remains constant on single activity level. Because by making changes in your budget figures, by having different activity levels, you can incorporate different scenarios for your planning. Okay? To whom it is suitable? It is suitable to the businesses. Those are operating in ever-changing business environments. Like when there is an ever-changing business environment, there is a requirement to create different scenarios. So in that case, flexible budget is more useful. So in that case, flexible budget is more useful. So when you are operating in a changing environment, you are creating different scenarios, and for those scenarios, you are creating different outcomes. So in that case, you're preparing your budget to incorporate those outcomes. Okay? It is also used for the companies, for the businesses, those are preparing to accomplish some unexpected turnarounds in events. For instance, let's assume the overall environment is stable, but you are expecting for your specific business that may incorporate some unexpected events during next accounting period. So in that case, you are developing different scenarios for your budget for having different activity levels to incorporate at which activity level you are beneficial. You will identify the activity levels where you are having losses, so you can avoid those losses. For instance, no one was predicting this COVID-19 pandemic. So this is unexpected turnaround in the event. So here you have to now make different plans. Plan A, plan B, plan C, plan D, etc., etc. So over there, you require flexible budget which have cushion, which have margin to change the budget by having different activity levels. What is the difference between flexible budget and static budget? Very simple. When you have flexible budget, you are allowed to adjust on the changes in your assumptions. So it means you can create different scenarios, you can create different activity levels for them. You're preparing a budget. On the other side, static budget remains constant. The assumptions which you have made at the time when you prepare the budget, you are not supposed to make any change in your static budget. So the principal difference between flexible budget and static budget is static budget is not going to be changed, but the flexible budget can be changed according to different activity levels. What is the format? This is proposed format. Keep in mind, in management accounting, in planning, budgeting, and forecasting, you don't have any standard format to do the workings, to prepare any document. The organizations can amend the format according to their particular needs. So this is the proposed format. You can make it different. Here, I'm making the assumptions to prepare the flexible budget for your actual activity level. So this is 20,000. So your static budget was at proposed activity level of 24,000 units. So this is your sales revenue. This is your direct material cost. This is your direct labor cost. This is your variable FOH at activity level of 24,000. Then you have contribution margin on this activity level. Then you have fixed FOH, and then you have operating profits. So all these figures are based on static budget. Now, you have created the scenario. You want to prepare your flexible budget at your actual activity level. So this is second scenario. Static budget you have prepared on your planned activity level, which was 24,000. Now you are preparing your flexible budget at activity level of 20,000. Now look, all the costs, those have variable characteristics. You are supposed to identify those. Like in this simple scenario, it is identified, but in some complex questions, which I will discuss in any other video, by having working on Excel sheet, like here, direct material cost is by behavior variable cost, direct labor cost is by behavior variable cost, and variable FOH is a variable cost by behavior. So you are supposed to adjust your variable cost for the proposed activity level, which is now 20,000. So first of all, we calculated the variable cost per unit at static budget activity level or any other activity levels you may have. Like this is 1440 divided by 24. I'm just eliminating the thousands figure. So 1440 divided by 24, it is equal to 60. So your direct material cost per unit is 60. We multiplied it with activity level of 20,000. So 60 times 20,000 equals to 1.2 million. Okay. Again, direct labor cost. In this very simple question, you have identification which cost is variable, which cost is fixed, and here you don't have case of semi-variable, but in some complex questions you may have case of semi-variable, variable, and fixed. Like direct labor, it is 384 divided by 24 activity level. So 384 divided by 24 equals to 16. So 16 times, let's assume, which is the activity level 20,000. So time 20,000 equals to 320,000. Now variable FOH 288 divided by 24 equals to 288 divided by 24, 12. So times 20,000, which is equal to 240,000. Now come towards sales revenue. Again, we will do the same working. 288,000 divided by 24 equals to 120. So per unit sale price is 120 times 20,000 2.4 million. So by subtracting all these figures, we got contribution margin. So this is the figure of contribution margin. So we adjusted, we used standard price and activity level. So we used standard price, which we calculated by having the data of static budget in this question, but it may be different working for having some complex questions. I will elaborate you later on. But keep in mind one thing, that all the costs, those are fixed. So all the costs, those are fixed, like this one will remain same from one activity level to second activity level, like from 24 to 20,000 it remains same. It doesn't change because we know the behavior of fixed cost. It doesn't change when your activity level changes. So this is like in complex questions, first of all, you have to identify, if it is not given you any hint, which cost is your variable, which cost is your fixed. And when you have semi-variable cost, in that case, you will again bifurcate it into variable and fixed by using high and low method. Okay, so it remains same fixed cost, but your all variable cost and your sales revenue will be changed according to the activity level, and then you will calculate your operating profit like we have calculated here. So this is the way how to prepare the flexible budget. You are supposed to adjust according to your scenarios, which can be your actual activity level, which can be your actual activity level, which can be any other budgeted activity level. Like here it is 20,000. Let's assume we can make it for 16,000. I'm making just the working for the activity level of 16,000. For the activity level of 16,000. So your activity level is 16,000. In that case, keep in mind we have calculated per unit cost, which is 120 sales revenue per unit, 60 direct material cost per unit, 16 direct labor cost, and variable FOH 12. So I'm erasing this data to do my calculations. Let's assume here 16,000 times 120 equals to, let's do the calculation, 16,000 times 120 equals to 1.92 million. 1.92 million. So this is your sales revenue. Direct material cost 16,000 times 60. So it is equals to 960,000. Then direct labor 16,000 times 16. So 16,000 times 16 is equal to 256,000. Then 16,000 times 12 equals to 16,000 times 12, 192,000. So your gross contribution is 1920 minus 960 minus 256 minus 192 equals to 512. Triple zero. Next, fixed FOH cost, which is 552000, because it remains static, constant on every activity level. So net operating profit or loss here in this case we have 10,000 loss. Okay. So by having different scenarios, like here in my original calculation, the scenario was actual activity level, which is 20,000. Now this budget, the flexible budget at actual activity level, will be used to calculate your various analysis by comparing your actual results with your flexible budget result at actual activity level. But here this scenario will give you the plan that if you will produce only 16,000 units, you are loss making organization. So in this case, you will do the things. Okay. So this is the way how to prepare the flexible budget. Now discuss what are the benefits we are having by adopting fixed budget, flexible budget techniques. Flexible budget enables management to focus to attention various costs by factors other than differences between actual and budgeted volume. So one variance is due to the volume, but other factors You can compare by comparing, by having variance analysis by comparing your actual activity flexible budget result with your actual results. So this is also called flexible budget variances or total variances. So you can dig down from there what are the major reasons behind the variances. Next, it will avoid the overspending because you have planned the different scenarios. By having plans for different scenarios, you would be able to understand what is like where you have extra spendings. Flexible budget allows you to increase spending to take advantage of opportunities. Now, in one case, you can increase your costing budget when you may feel that the additional revenue which you are generating by increasing your activity level is greater than the cost which you are incurring. So in that case, your cost budget you can increase to avail the benefits of having additional revenues. It relies on current data, not only the previous data, like which is mostly used for the static budget. So by relying on the current data, you are incorporating the scenarios, the problems, the opportunities of today's time. It has adaptability, like it can adopt the different levels of activities as we discussed earlier. Now let's move towards the disadvantages of flexible budget. The first disadvantage is it is complicated to prepare because you are supposed to create different scenarios which have different numbers and natures are complex. So the assumptions you are using for those scenarios, it is also very like difficult task to make the assumptions those would be accurate. So when you have different scenarios, it is a matter of confusion for your employees. So which activity level is their ultimate target or goal? What they are supposed to achieve? They have confusion about that thing. Then it requires standard costing system. So flexible budget is no more useful without having standard costing system. So they are both relying on each other. So if organization is using flexible budgeting, it means they are supposed to apply a standard costing system. So these were the disadvantages of flexible budget. Thank you very much for your time. I hope you may have enjoyed my lectures. So please subscribe my YouTube channel and press bell icon to get notification about my latest videos, and also share in your circle if you have enjoyed my lecture. Thank you very much for your time.